What's going on, everyone? So in today's video, we are going to be breaking down the VA loan requirements, as well as some frequently asked questions about VA loans. So if you're a veteran looking to buy a property in the near future or down the road, definitely want to watch this full video. And a little background on me. I'm an agent that has sold well over 100 million, and I have one of my top lenders, Alex Nersini, who has also sold well over 100 million. So we're going to be just breaking down everything we know from our own experience. And if you have any other questions that maybe we didn't cover, feel free to drop them in the comment section below or reach out to us at any time. So to start with, COE.
So it stands for a certificate of eligibility. That is what we need in order to even proceed with a VA loan. People who would be qualified and would be able to obtain a COE would be someone that's a veteran, that's active duty or recently discharged. Also, people in the reserves as well.
Okay. And how do you go about getting a COE?
Yeah, so it's pretty simple on our end. So once I get someone's loan application, and even before loan application, if I just have their date of birth and I have the last 4 digits of their social security number, I just go in the VA loan portal, and it will allow us to just obtain the COE very quickly. If for some reason it's not in the VA loan portal, what we'll do is we'll just have the veterans send us their DD-214, which has all the veterans information on there. And we should have it probably within 1 to 3 days once we submit it to the VA. So it's pretty simple.
Okay, so it's pretty straightforward. And then once you have that, as far as the documents needed to get approved, and this is pretty much true with any type of loan, but you guys look at like last 2 years, W-2, 30 days pay stubs, 2 months bank statements, gift letters, and obviously like a completed loan application. If I was filling out an application right now, that's what you would ask for pretty much.
Yeah, it's very similar to like a conventional loan or other loans out there. There are some guidelines that are a little bit different with the VA loan, but in terms of like the documentation needed, it's very similar. So yeah, just last 2 years of W-2s, last 30 days of pay stubs, last 2 years of tax returns if we need them. Sometimes we don't need them, and then like 2 months of bank statements. That's like the standard stuff. And if it's more complicated, like someone has a business they own, then we need business bank statements and business returns as well, tax returns as well.
Okay. And if you're self-employed, it sometimes takes a little bit longer. If you're W-2, then you can get an approval. Like, how long does an approval take to actually get done? You can turn it around pretty quickly, right?
Yeah. So yeah, the pre-approval, it depends on how complicated the situation is, but usually I can do a pre-approval, same day, assuming I get the loan application kind of earlier in the day. What I'll do is I'll just pull credit, and just get all their pay stubs, W-2s, bank statements. That's the type of stuff I need for the pre-approval. The pre-approval is a little bit easier, assuming the client's like salaried, shouldn't take long at all, usually same day.
Okay, cool. And then as far as the minimum credit score, and with the VA loan, like each lender, pretty much every lender is going to have like general requirements, but lenders might have slight differences here and there. But what do you guys require as far as minimum credit score?
Yeah, I would say, like the standard, most companies is 620 credit score, but we've done them before with exceptions like under 600. So, I've done one at 580, but you need to have like the exceptions, to allow that would be having maybe more money for reserves, after paying for the property, how much money is left in their bank account, a low debt to income ratio, that type of stuff. But it is doable under 620. You could even go to 580 if you needed to.
Okay. And then as far as down payment requirements for a VA loan, most people think of the VA loan 0% down, but what do you typically see people putting down?
Yeah, I would say most veterans, the first time they're purchasing a home is 0% down. Now, the client that's maybe selling a house and purchasing a new one, usually they take that lump sum money and put it, as a down payment. But the majority of veterans are putting 0% down. I'd say like slightly over 60%.
Okay. So most people put 0% down, but you're not required to. Like, if you want your monthly payment to be lower, you have some cash sitting around, you could always put down. You can put down as much as you want. You can put down 50%. You can put down 10%, 20%.
Yeah, exactly. Yeah, you can put as much down as you want, but like the reason why 0% down is a little bit more popular is just because the interest rate's pretty much the same from 0% down to 50% down, right? So that's not the case for conventional loans. Like the more money you put down, typically your rate will improve. Now, I don't know if we're going to talk about this later, but another thing I'll mention here, because we're talking about down payment, is there's a VA funding fee. Now, that can change depending on it, if it's your first time using the VA eligibility or second time. Also, it depends on what your down payment is. So if you're putting like 0% down and it's your second time using a VA loan, you're going to have the highest VA funding fee. It's going to be 3.3%. It'll be added onto your loan. Like you don't have to bring that to the table at the closing table, but it's added on a loan. So basically you're just starting with 3.3% less equity. Just think about that way in the home. And
So you don't, I always thought you had to bring that as like part of the closing costs. Like you can just wrap that into the loan.
Yeah. You just wrap that in the loan. So like, you know, if you're putting 0% down for a VA loan, and let's say it's your second time using your eligibility, you'd actually start with negative equity, right? Because you're going to add that 3.3%, assuming you don't pay it at the closing table. You know, you'd start. You end up starting with like negative equity in the house, which is possible. And then like, so another a couple other like tiers on the VA funding fee now that we're talking about is if you put 0% down and it's your first time using a VA loan, then the VA funding fee will drop from 3.3 to 2.15%. And then if you end up putting 10% down or more, it'll drop all the way down to 1.25%. So those are kind of like the different tiers.
Yeah, no, that's definitely good to know. And before we jump into that, if you're looking to buy or sell we're in the DC area, but we can also help you out nationwide. So if you're looking to buy or sell soon, just reach out to us below. I'll put a link to a quick form, and then we'll follow up with you, and would love to assist you. And then as far as we briefly touched on the DTI. So I always thought that, 41% DTI, and you can talk a little bit more about DTI so obviously I'm an agent. So I would say, hey, if a client, everyone has, some clients have no debt, some clients have student loans, various types of debt. So I always refer them to you for further clarification, but you can work with different amounts of DTI depending on.
Yeah. I mean, like I always see that online. It's always published. The debt to income requirements always seem to be much lower than what we can actually pre-approve people for. So on a VA loan, it's actually one of the more like liberal debt to income ratios out of all the loan programs. So, just comparing it to what I've done in the past, I've done a VA debt to income ratio up to 58%, so it's much higher than like 41% that's published. Like the reason we can go up that high is usually there's compensating factors. Usually like a credit score that's a little bit higher, maybe like 680 or 700 or higher. And then they might have some reserves after they pay for the house, like how much cash is in their bank account. And maybe also like a lower debt to a lower debt to income ratio, would probably be for more like conventional loans. Like usually 50% is like the highest you can go on a conventional loan, where VA would be up to like a 58, sometimes 60. I mean, I've heard of other people getting up to 60 before, but I've only personally done 58.
And what, just so for clarification, debt to income ratio, what exactly is that? So that's just.
Yeah. Good question. So you're just comparing like what is their monthly expenses versus monthly income, and that's how you come up with a ratio. If someone has a salary of 100,000, you just take that's their annual salary, divide that by 12 to get their monthly gross, before tax money, and then you look at their monthly expenses, and the only monthly expenses we care about is what shows up on their credit report. So like we don't care about utilities. We just care about like, do they have student loan debt, credit cards, car payments, do they have other mortgages, that type of stuff.
Okay, cool. And it's always good to be upfront about this, because the lender, they're going to run your credit initially. And actually when you guys do the pre-approval for VA, is it a hard check or soft?
Yeah. So we have the ability to do a soft credit check. And that will only be for the pre-approval. And then when we have a ratified contract, then we have to do a hard pull. That's required by the VA. But yeah, for pre-approval, we can definitely do a soft pull.
Okay. And yeah, I was going to say in regards to DTI, because I've seen it before and I've heard about it before where people try to like hide different, debts and things like that. And it's obviously good just to be up forward or, straight up front with it because the lender's going to find out about it one way or another.
Yeah. I mean, it is tough. Like there are instances where people might just forget, like some people have child support or something that doesn't show up on their credit report, or they might have alimony, that type of stuff. Like we do typically catch, like if it's not on the credit report later in the process, so that could be problematic. So that type of stuff, you just have to like mention it to the loan officer so they can include that debt in there. And then also, just don't try to buy anything like while you're in the process, like a car or big expenses that'll like increase your monthly expenses. That could definitely have an impact on a negative impact on your pre-approval.
Yeah. And yeah, you don't want to make any big financial changes like changing jobs, buying a car, buying large pieces of furniture, running up any types of debt. You want your financial picture to be exactly the same or better than when you applied.
Yeah, exactly. And look, if you get the best job opportunity in the world, just talk to your loan officer about it. Like, cause it could work out, right? Like if you're getting a huge raise going to another company, like don't say no because you're buying a house. It could work out, like if you're just going from a salary to another salary, it's possible that wouldn't really have a negative effect. But if you're going from a salary job to now being self-employed, you probably wouldn't be able to buy anything, just because self-employment income requires 2 years, of history.
Yeah. And you also, I remember I had somebody that they were asking me about changing jobs and I was like, yeah, I was obviously like, no, don't do it. But I think shortly after they got the loan done, after the house closed, then they changed jobs. So you can always push it off a little, it only takes about 30 days to close. So you can just wait about a month.
Yeah, exactly. I mean, yeah, just talk to your loan officer because I mean, there's definitely workarounds, and yeah, I've done that before, where someone like was in that same situation, and what we had to do is just like put off like accepting a job until right after, and it worked out fine. But yeah, just talk to your loan officer; they'll be able to advise you on the best route.
Yeah. Basically, don't like if you read something on the internet, like I mentioned earlier, every lender is going to have their own requirements. So always double check with your lender before you make any type of big decision because they can get creative. They have different ways of working through things, and each lender is going to have different requirements. Next up, property standards. So this gets a lot of people talk about this a lot, that the VA appraisers are pretty strict. And in my experience, it's like, it's more for egregious type of things. If the roof is falling in, if there's broken windows, you need handrails in the basement. But I don't know, it's not too crazy. The VA just basically wants to make sure that there's like a standard of livability there.
Yeah, they do have like the one thing people most commonly run into it. This has happened to me, probably once a year on average, where when I'm doing a VA loan, is if someone's buying a property, like the appraiser will always mention if there's not like a handrail on any of the stairs, like let's say it's a front porch, there's only 2 or 3 steps, and there's no handrail, like the appraiser is going to require a handrail to be added before closing.
Yeah, I've had that happen a few times.
Yeah, like because like especially when you're buying like older properties, you're just like people just don't always they're not always putting handrails, on 2 or 3 steps, right? So it definitely happens, but that's the most common. But yeah, I would say 90% of appraisals are just fine, maybe even higher than that, maybe like 95%. It's rare you run into anything, but like that is something you can't waive, unfortunately, with the VA loan. Like you need to have an appraisal contingency in there, so it's required.
Yeah, which is like good and bad. It's good because it protects the buyer because the buyer is going to be getting a property that's been looked at by a VA appraiser to make sure it's in livability condition or livable condition. But on the downside, you can't, if you're making offers, you can't really waive the appraisal contingency. So sometimes in multiple offers, you try to waive as many contingencies as possible. With VA, you can't really do that.
Yeah, exactly.
But you can still find great deals, and you can still make very competitive offers without waiving the appraisal. Next up, so what's great about VA, and well, really lots of conventional loans, but I don't think most people even think about this. It's not even on their radar, and we talk about this a lot. But you can buy up to a 4-unit apartment building. So you can buy a duplex 3-unit or even a 4-unit apartment building, live in one. The VA appraiser is going to use the income from the other units to help you qualify for the one that you're living in, and you're required to live there for a year, basically.
Yeah, it's probably like the best if you're eligible to get a VA loan to buy multiple units, because you can put as little as 0% down and buy multiple units, which that's like an investor's like dream right there, right? Like spend no
Yeah.
money on the down payment and then be able to buy multiple units. So yeah, it's up to 4 units on a VA loan. And the best thing about this is that you can use income from the other 3 units to help you qualify for more. So if you're qualified for, let's say 400,000 with just your income buying 1 unit, but then let's say you look at a 4 unit, and what we'll do is we'll look at what are the rents that you can get from the other 3 units and include that in your income. So maybe that like $400,000 house that you get pre-approved for jumps up to 800,000 because of that three other units of income that'll help subsidize that mortgage payment. You can
Yeah.
only use 75% of that income, and it's derived from the appraiser comes up with the rent schedule. And so you have to be conservative. Like when I'm pre-approving someone, I'm like, what's the most conservative rent for those 3
Right.
units? Because you just don't want to pre-approve someone assuming like a rent that an appraiser might come in and might drop that monthly rent by like $300 or $400, and then you're not pre-approved for the house anymore. So you want to just be super safe, because you can't really pre-approve someone exactly how you want to up front on this, because you have to wait for the appraisal to come back. And it's really, it's up to what the average rents are and what other 4 units are renting for. And it might be a little different than what you come up with. So you just want to be super conservative when you're coming up with that monthly rent.
And if it's currently rented out at like a lesser amount than market value, I'm assuming the appraiser probably just uses the current lesser amount rather than the market value. Because we see, at least in DC, a lot of times some of these smaller multifamily properties, they're not like fully optimized, and sometimes the rent is a bit lower than what it could be rented out for.
Yeah, I mean they're going to look at just comparables. So yeah, it's definitely possible it could be a little bit lower. You just want to be super careful when you're pre-approving someone that, especially as a high debt to income ratio, you just like want to be super conservative. You don't. The last thing you want to do is go under contract and you're stuck. Like,
Yeah.
And you got to just withdraw or cancel.
Yeah. And then, so I mentioned the intention is that you have to live there for 1 year. With VA, though, if you get a transfer or different things like that, you're not like, if something happens, somebody could move before the year is up.
Yeah, I mean, so like this is how it works. So like for VA loan, like you have to purchase it as a primary residence. And it's a little different where like the common rule is if you buy a home as a primary residence, you have to live in the property within 60 days of closing. Now, VA, like what happens is they're a little bit more flexible with moving in the house within 60 days, because in the military, you're constantly moving. And so if someone gets transporters, let's just say, like, for example, this is a recent deal I had where someone moved from Hawaii. They were on base in Hawaii and he got transferred to Northern Virginia. So he had transfer orders that showed a specific start date, and that was 100 days out, and he wanted to purchase a house for a VA loan. Now, if you have transfer orders and you have a specific date when he's going to start receiving that new income, you can qualify him for a primary residence, even though he won't reside there for over 100 days. And VA even has in their guidelines, they'll go up to 12 months sometimes. So it's pretty flexible. A conventional loan is way different. You have to live in the property within 60 days. So that's another positive for going with a VA loan. They're a little bit more flexible.
Yeah. So they're more flexible. And then after that year is up, you could, if you had a 4-unit, let's say, you could, or just single family, whatever it is, after that year is up, you could rent it out, because it just has to be a year that you live there as a primary residence, and then you can
exactly. Yeah. You can rent it out, and you can also own. I don't know if we're going to talk about this later, but I'll just mention now. You can own more than have more than one VA loan.
Yeah.
So like what'll happen is if you own a property and then you get transferred, you can buy another VA loan, buy another home with a VA loan. But what we'll have to do is order another certificate of eligibility.
Mm-hmm.
And you'll have to look, there's a calculation we do based on how much eligibility is tied up in that first property. You'll have to put usually a certain amount as a down payment in order to buy another home with a VA loan. But I've seen someone with 3 VA loans before, so it's possible.
Really? Yeah, because I always thought of it like you have your eligibility, let's say for $1 million, right? And then you buy a $750,000 property, and then you might have the 250 left over for the VA loan. So you wouldn't be able to buy like the same type of property, obviously, but I guess maybe if you're putting a ton down, you could get up there.
Yeah, definitely. Yeah, you definitely have to put some money down. It's also like the formulas based also on like the loan limits too. So it's kind of helped a little bit now that the loan limits are increasing over the last few years, a lot. So it helps.
Okay. And let's ask, I'm going to go over some frequently asked questions that we get a lot with VA loans. And before we jump into that, if you're looking to buy or sell we're in the DC area, but we can also help you out nationwide. So if you're looking to buy or sell soon, just reach out to us below. I'll put a link to a quick form, and then we'll follow up with you, and we'd love to assist you. So next question is PMI. So with VA loans, do you have to pay PMI?
Negative. So that's only for FHA and conventional. If you're putting less than 20% down,
Okay. And actually,
VA does not have PMI. It only has a VA funding fee. So that's an advantage.
And PMI, just to be clear, is private mortgage insurance. So if you're putting less than 20% down, it's a little bit riskier for the lender. So then they'll want you to pay this insurance until you get to the 20%. But actually with FHA, even if it's at 20%, the PMI doesn't go away for like 11 years.
Yeah, exactly.
Okay. Next question. We talked about using the VA loan more than once. Always talk to your lender, but yes, it basically is possible. How long does a VA loan take to close? Sometimes some people have some people think it has a reputation of taking forever, but at least what I've seen, we can close. I've seen it close in like 24, 25 days. You get the appraisal back, and you're required to get the appraisal back in like 14 days, something like that.
No, so yeah, like by law, like the appraiser has up to 21 days to get the appraisal back. But I've definitely closed and received the appraisal usually much quicker than that. It's just when someone is trying to put an offer in on a home and they want to use a VA loan, I tell them like put in 22 days just so just in case the appraiser does wait till the last day to give us the appraisal back. It's way different. Like a conventional loan, there's appraisers that will be able to do rushes, and like you can request rushes through VA, but they honestly they don't. We don't have as much pull with VA appraisers. I would say 22 days. You can close a loan pretty safely in that time frame. And I've done sooner than that. I've done 14 days. But you have to just make sure everyone knows that like the appraisal could hold it up potentially.
Yeah.
Go ahead.
Okay. So, and that's an important thing to ask your lender. That's why I like working with Alex, because they can close in 30 days. So if you're trying to make competitive offers and your credit union is like, yeah, we can close in 45 days, no problem, 60 days. That's not a competitive offer unless there's no other offers, the property's been listed forever. You want to close as soon as possible. So you can tell the listing agent, hey, got a great lender, we can close in under 30 days, that kind of thing.
Yeah, absolutely.
Another one. So VA loans, they're assumable, and anybody can actually assume a VA loan as long as they qualify. It doesn't have to be a veteran. But if you're a veteran and a non-veteran assumes your VA loan, then you lose that eligibility with the VA loan, as opposed to if you let a veteran assume your assumable VA loan, then you would get that eligibility back. So that's just something, I guess I just wrote that down. That's just something to keep in mind.
Yeah. I mean, so like these questions are, I don't know if you've Jeff, I've heard this a lot from other people, but everyone's interested in like assuming mortgages now because rates are much higher. So everyone wants that like 2.5% mortgage that they can assume, which look, it's possible to do. And you know, what happens is that like you have to talk to the current veterans servicer, and it can be, you know, a 60-day close to like get approved to even just assume the mortgage. Like they have to go over all your income. So you're kind of like, I wouldn't be doing the assumable mortgage. This is done by like the current veteran servicer, like who, let's say it's Wells Fargo currently has like the mortgage and it's at 2.5% in a non-veteran wants to assume it. So you have to go through all these hoops to try and do that. And Wells Fargo might say it's going to take 60 days. Does the seller want to wait that long, right? Probably a desperate seller would be okay doing that, but some won't. So just something to think about there.
Yeah, you see assumable loans everywhere or being advertised, but in reality, how many of them do actually go through with it? Probably a pretty small amount, because you have to get approved. It's going to take, most sellers don't want to take 60, 90, 120 days to close on their property. And then the buyer has to make up the difference, usually in cash. I know there's some loan programs that offer like a second, but if the VA loan is at like $600K and they're listing the property for $800K, then you would have to make up the difference and convince the seller to spend 2 or 3 months further to close the property. So there's definitely more hurdles. I mean, it sounds really nice, but it's not always possible. Next up, can you buy a foreclosure with a VA loan?
Actually, I've never done that before personally, but you definitely can, as long as it's in a good state. Like most foreclosures might be in a rough condition. So, you just want to check. I mean, there's not that many foreclosures right now, right? Like, I mean, most people, they have so much equity that they'll just sell their property before it gets foreclosed on. Why would they get foreclosed upon? That makes no sense. So you just don't see that often anymore. But yeah, you can buy a foreclosure. You just got to make sure it's in the right condition for a VA loan. That's all.
Right. Because what's going to happen is the VA appraiser is going to go through the property, and every now and then, like we don't have a ton in the DC area, but depending on where you are nationwide, because we can help you out nationwide, some foreclosures are in good condition. I've seen a penthouse foreclosure. I've seen really nice properties sometimes that are foreclosed on, but the VA appraiser is going to say, hey, you need to do this or you need to do that. If it's in bad condition and the windows are blown out and everything, they're obviously not going to lend on that type of property. So it just depends on the type of condition of the house. Okay, so with a home inspection, so I had a buyer recently who was saying that his friend bought a property, and he was saying that it's required to have a home inspection with a VA loan. I think he was just thinking of the VA appraiser, but you're not required. It has to be in relatively livable condition, but you're not required to do a home inspection. You can make your offer more competitive by waiving the home inspection. You just need to make sure that it's going to pass the livability standards for the most part.
Yeah, no, I mean, you're absolutely right. So that's probably the best way to put it. Yeah, just make sure on a foreclosure, just, I wouldn't even put an offer in if let's say there's like holes in the wall or utilities aren't working, you just pass on it, because they're going to require a bunch of repairs, and like they're not going to do repairs before you buy the house. So
they're not. They're not. The seller, if it's a foreclosure, the seller's not going to fix anything for the most part.
Yeah.
But I have seen it. I think it was a VA loan. This was a while ago where there was no refrigerator, and I believe it was VA, but I think they required a refrigerator or some type of appliance. So the buyer ended up buying the appliance just on his own dime, putting it in there, and then resubmitting it to the for the file, and then they were able to purchase it that way.
Yeah, that I've seen that happen. It's happened to me once before too, and it's rare, but yeah, you can definitely do that.
Okay, and now as far as approximate closing costs for a loan, what are the general, talking like 3% in closing costs? Like if you put 0% down, first time VA buyer, let's say the purchase price is $500,000, you're looking at about $15K in closing costs or so.
Yeah, I mean it's assuming you're just doing like a 0 point, like let's say like you're going with like a standard like 6.5% at 0 points. But if you want to buy down the rate, it could be up to 4%. Sometimes people want to buy down the rate, but yeah, typically I would say 3% of the sales price is what your closing costs will be. That's a safe number. And, you could get that number down to essentially zero if you're able to negotiate a seller credit, which you'd have to talk to like your realtor, like Jeff, to see if that's possible. Because if there's multiple offers and it's only been on the market for 2 days, they're probably not going to get a seller credit.
Yeah, and actually, we just did one somewhat recently where the purchase price was like 800, and then it was like we offered 830, but then 30K in seller credit to buy down the rate a little bit, to make the monthly payment a bit better, but also to pay some of the closing costs. So you can always increase the price, or if it's just been sitting on the market, you can just offer asking price with a 10, 20, 30K. You can ask for 40K credit. Like, you're not allowed to get money at closing, correct? But you can ask for,
Yeah, I think it's like up to like on a VA loan, I think it's up to like 6%. I think it's like the max, which like no one really gets that high on the seller credit. It's rare.
Yeah.
But yeah, you can get the 6%.
Okay. Now, as far as VA appraisals, if a VA appraisal comes in low, how does that process work?
Yeah, so if the VA appraisal comes in low, they'll need to bring like if they're putting 0% down, that would cause. Well, first off, there's a VA appraisal contingency in there, right? So first thing you would
Yeah. So you're not waiving. It's not
Yeah.
traditional. So you do have the contingency.
Yeah. So like this is kind of like
Tidewater.
Yeah. So like the three things you can do with with a VA appraisal contingency in there. First thing you would do is negotiate it. You would negotiate with the seller. You would try and get the price down to what the appraised value is. Let's say it's 5,000 below. You would try and negotiate the price down to the fair value. If that doesn't work and you're putting 0% down, VA is going to require you to come up with a difference. So you'd have to put the 5,000 as a down payment to make sure you're not starting with negative equity, right? So assuming that you don't want to do that either, then you could just back out of the contract, right?
Yeah.
And then you get your earnest money deposit back. So those are the three options.
Yeah. And in the contract, it'll usually specify like, it'll say like 3 days to go back and forth and negotiate an outcome. And I'd say in my experience, and I think also what happens is the VA appraiser will give you a heads up if the appraisal is going to come in low, and then you send them kind of like some of the numbers to justify that sales price, or the listing agent typically sends them the numbers to say, hey, it's worth 500,000, and the appraisal, let's say it comes in at 480. Then I would typically go back to if I'm representing the buyer, I say, hey, yeah, let's ask for the appraised price. And the seller might say yes. They might say no. They might meet you in the middle. But there's, like Alex said, you have three options. You can negotiate, you can just back out, or they can come all the way down to the appraised price. And most sellers are going to usually negotiate a little. They might not go all the way down, but they'll go down a little bit, at least in my
experience. I would say like meeting in the middle is probably the most common, right? But I've also seen people just literally give them the appraised value. But most common is probably just meeting in the middle somewhere.
Okay. So getting a VA loan after a bankruptcy or foreclosure, I think it depends on the type of bankruptcy, but I've heard it's about 2 years. I think I saw somewhere like 1 year, but just to be on the safe side, 2 years before you can apply again for a VA loan.
Yeah, like so it depends if it's Chapter 7 or Chapter 13 bankruptcy, but yeah, like it's typically 2 years. And then if there's a property involved in the bankruptcy, that's a little bit more risky because you're literally you're obligated to pay on a mortgage, but because of the bankruptcy, that debt was wiped out. I can't remember if that's Chapter 13 or 7, but the one that includes the property, it'll require like a 4-year waiting period before you can buy another house. So that's kind of how it works.
Okay. And obviously always ask your lender because you might get different responses depending on if you just talk to like a standard bank versus you talk to Alex, maybe they have something they can figure out. The next question, do you need a veteran lender or can any lender do a VA loan? I actually had a buyer recently and he thought that it was only like a couple companies that did like VA loans. And I was like, no, like VA loans are pretty common, at least, in our area, in the DC area. And then I also showed him like when you're looking for a lender like Alex, you want someone that's responsive and also that has good reviews. So I showed this guy the reviews of the company that he was going to use, and I was like, I cannot, like, I wouldn't be doing my job if I recommended this company. They were like 1.5 star reviews, all of these terrible reviews. It's like the worst experience ever. Do not use these. And he that's who he was going with, because he thought that you could only kind of use this one type of VA lender. And I was like, no, man, there's a lot of options out there.
Yeah, yeah, for sure. I mean, most lenders like are able to do VA loans. You probably want to like interview, I would say, a couple lenders just to see, like, ask like the basic questions, see who seems the most knowledgeable, check the reviews. Also, I mean, Jeff will tell you this too, is like a local lender. I would say like a local lender that's reputable in the area is probably the best route, because you're gonna want a pre-approval letter from a lender that the seller's agent recognizes, right? Like that's huge. Sometimes you'll see Bank of America, right, Jeff, and you're just like, oh, like,
Yeah,
like as a listing agent, and you're definitely have that like in the back of your mind, like, I know they're pre-approved from Bank of America, but like there's also another offer from a local lender, same price, like, that could be the deciding factor, right? Like that's
yeah.
happened.
Yeah, when you're making an offer, you want like every possible advantage going your way. So if there's two offers that are exactly the same, one is from Bank of America or some bank where it's just like a 1-800 number and you can't get in contact with them, the listing agents typically will call the lender. So like what's great with working with Alex is like sometimes, a lot of times, we're making offers on the weekends, evenings, obviously past 5 o'clock. So a lot of big banks, you can't even get in touch with anyone past 5 o'clock. So it kind of puts you at a disadvantage if your lender, number one, has terrible reviews, but also is not responsive. So yeah, Alex is definitely a great resource for VA loans or really any type of loans. Um, and yeah, that being said, if you're looking to buy or sell in the near future, just reach out to us below. I'll put a link to a short form, and yeah, we'd love to work with you.